Hello, this is Jordan. This video is being recorded on the early afternoon of Monday, June 12th, 2023. Thank you so much for joining me today. Make sure you subscribe to the channel. I got a lot of great content coming in the weeks and months ahead. Don't want you to miss that. Okay, so in this video, I'm going to talk about the three best historical comparisons for gold, or three of the most relevant, because sometimes you can make all these different historical comparisons, but they're not really relevant, in my opinion. So I did a video a couple weeks ago talking about with what I think is the best historical comparison for gold. So that's number one on the list, and that is the 1964 to 1965 period. So in this chart, we have gold at the top, gold stocks there below, then the S&P 500 below that, and then we have my expected returns indicator at the bottom. Those are expected returns for a 60-40 portfolio. You start at the bottom, you see early or just the entire 1960s period, very low expected returns moving forward. That has been the case since 2018, 2019. And you go back to the 1960s, and I've made the point so many times. Yes, the secular bull didn't end until 1968, but it really ended before that in real terms, because from 62 to 68, I think the S&P only went up 50%. So your returns and your real returns, especially in equities, are really maxed out there in the early to mid 60s, although you did get some help from dividends. Okay, but that aside, we're focused on precious metals and gold specifically. And so I think the macro, I've talked about it so many times, but I think the macro today fits really well with, somewhere in the mid to late 1960s. And looking at gold, of course, it has this bullish cup and handle pattern. It's tried to break above 2050, 2075, 2100, whatever you want to call it. And, just had a failure a month or so ago. But it's still in really good shape. Looks like it's probably going to break out sooner rather than later. And this is going to be a very significant breakout for gold and precious metals as well. And so looking at gold, this has to be the most significant breakout since the early 70s when they let gold go. Looking out, the 2005 breakout, breaking that 20-year down trend line was significant. But, when you're breaking out to a new all-time high after that long of a base, it's really, really significant. I talked about, this could be similar to the breakout in the stock market in 1982. But, you go back, pre-1971, the gold stocks were really the proxy for precious metals. And also for, they're really the inflation proxy. So if you really wanted to get inflation protection, you only could invest really in energy stocks or gold stocks. You didn't have tips, Forex, emerging markets, and all those types of things. So, for all those reasons, gold stocks are really they're really, back then, they're what gold is today, in my opinion. And so if gold was not fixed in price and it was freely traded, you would have seen it breaking out in the mid-1960s. And in that video where I did the best historical comparison, I talked about the Paris gold market and the gold price in Paris and how that broke out, I think, in 1965. So looking at the gold stocks here, that big breakout in 64, 65, I think that the gold breakout that we're going to see, historically, the gold stocks breaking out in the mid-60s, that's really the best comparison. So enough about that. Let's get into the other ones. So the 1968 to 1972 period, this is really interesting. Let's start at the bottom and talk about some of the macro. So you had the CPI breakout in 1965, and so inflation became a problem for the first time, really, since the mid to late 1940s. And the Federal Reserve, they started to raise rates in 1967. And so they hiked quite a bit from, just below 4% up to 9%. Then you had the recession in 69, 70. CPI came down. So macro-wise, it was very, very similar to today because it was the first time in many, many years that inflation broke out, became a problem, and also the first time that the Fed really had to hike rates to get inflation down. So very similar to today. Also at the same time, you had the end of a secular bull market in the S&P 500. And so I think, assuming we get a recession, the market comes down, it's possible that the secular bull in the S&P, is on the cusp of ending. So, I mean, these are some strong similarities today with respect to, what happened there in the late 1960s. And then you look at, let's look at the market, the gold price, gold stocks, silver. Look at how long it took these markets to surpass their 1968 highs. Looking at silver, it took almost 5 years. I mean, you could say about 4.5 years for it to rally back to that 1968 high. For gold stocks, looking at that, pretty much the same, 4.5 years. And then looking at gold, whether you measure the peak in gold in, the middle of 1968 or when it started falling in early 1969, that comes out to 3 years or 3.5 years that it took to get back to that high. Now, interestingly, if you look at that chart of the Paris gold price, it took about a little bit less than 3.5 years for it to break out to a new all-time high. But when the market started its move and really began to accelerate towards a breakout, that to that point, the correction was about 2.75 years. So that information, as well as the information I just mentioned with respect to gold stocks, and silver, it's all helpful with respect to the current market. How long it is taking precious metals to begin a new bull market, and for gold to get back to all-time high resistance and make this huge breakout. Now, this is more of a technical comparison, not fundamental. It's technical, but it's a viable comparison because the technical similarities are quite strong. And so what I'm talking about here is basically the early 2009 period. So let's start at the bottom. Let's start with silver. And we can see, just compare those rectangles. And so, silver had this big rebound, and then it chopped around, but with an upside bias. So we could say it grinded higher into, around the second quarter of 2009. But, twice it tested the equivalent to the 200-day moving average. The first time it, came below it, but then, had to move higher. Then it had a sharp correction. But the second test, you can see that was a very successful one, didn't go below. And then silver kept moving higher, and it had to do so when it rebounded. It had to make that move higher to get back up to the previous high. And so if you look at where we are now, I mean, it's very similar. We had this rebound, and silver it's kind of grinded higher, you could say. I mean, it had that first test of the 200-day, went below it, moved higher, and now it's correcting again. And so we'll see if silver, it definitely is a possibility that you could see silver come down, but successfully test the 200-day rebound, and then move higher towards that resistance at 27.28. So very interesting similarities, and let's talk about gold as well. We can see gold is on the cusp of a huge breakout like it was in 2009, although this will be a far more significant breakout. And so before gold made that breakout. It had one test of the 200-day. It tested the 200-day, then it rallied back up to the high, which, would have been the fourth time. So, that was the fourth test in the 08-09 period. It hasn't had a fourth test yet, but it did already test the 200-day. So I don't know. Perhaps it could test the 200-day again. If you look at right before gold broke out there, it did have one more test of the 200-day just right before the edge of that rectangle. And, then of course it made the breakout. So who knows? Possibly gold comes down, gets close, or it actually touches the 200-day line there in the mid 1800s. Then it rebounds back up and breaks out. So, that, if you're looking at those bullish scenarios, that includes some more weakness at first. That's still similar to how the 08-09 period played out and how that consolidation resolved to the upside. Okay, so that's it for these top three comparisons. Next time I do something like this, I'll probably see if I can do the video with a mouse and an arrow and that sort of thing. It probably would be easier to get the points across to you guys, and rather than just listen to me describe them and wonder where I am on the chart exactly. But that aside, let me know what you think in the comments. And thank you so much for tuning in. I look forward to doing another video for you guys.